The collapse of Silicon Valley Bank.
Silicon Valley Bank.
Silicon Valley Bank, the nation's 16th largest bank.
Greatest bank failure since the financial crisis of 2008 that sent shockwaves through global markets and left billions of assets of businesses and investors stranded.
Hi everyone. In only 48 hours since Wednesday, 8th of March, we have witnessed the collapse of one of the oldest and largest banks in the world. In this case study, we are going to discuss what is Silicon Valley Bank, what exactly happened that led to its collapse, and what are the next steps and potential implications for the broader economy. I'm going to explain all of this in such a simple way that even a 15-year-old would understand. So let's get started. What is Silicon Valley Bank or SVB? Just like you store your money in traditional consumer banks like HDFC, SBI, similarly, venture capitals and startups store their money in Silicon Valley Bank. How? Well, venture capitals raise money from limited partners or LPs. These LPs are generally institutional investors like pension funds or insurance companies. VCs need somewhere to store their money, so they go to SVB and tell them to store their money. Similarly, startups raise money from venture capitals, and startups also use SVB for storing their money. SVB was founded in 1983 and was the go-to financial institution for over 2,500 VC firms and over half of US-based startups. So what happened? Let's break it down into three simple parts. Number one, SVB's deposits grew 3 times from 2019 to 2021. In 2020, a lot of money was pumped into the economy. There was a big boom in startup funding and VCs were pouring a lot of money in startup ecosystem. Venture capitals also raised a substantial amount of money from their LPs. And guess what? Everyone went to SVB to store their money. As a result, SVB's deposits grew from $61 billion in 2019 to a whooping $190 billion in 2021. Number 2, SVB invested a part of this surplus money in government bonds. Now, this is not an unusual thing to do. Many banks invest their deposits in government bonds. Why? Well, they want to grow their money, and these government bonds are regarded as low risk and stable assets. As you can see, the total amount invested by SVB in investment securities increased from 47% in 2019 to 70% in 2021. A part of this amount belonged to treasury bonds and another part to mortgage-backed securities. To be specific, SVB had a $21 billion treasury bond portfolio with a yield of 1.79% and a duration of 3.6 years. But what is the problem with these bonds? The problem is that your money is locked in the bonds until they mature, unless you sell your bonds. Number 3, US Federal Reserve suddenly increased the interest rates to control the inflation. Now, if you look at this chart, you will see the sudden spike in interest rates. This resulted in a decrease in the value of bonds that Silicon Valley Bank held. Because SVB purchased the bonds during this period when the interest rates were very low, but now the interest rates are high. Imagine this, if I were an investor in 2023 and I have the option to purchase a new bonds with a higher return, why will I go and purchase a 2-year-old bonds with a much lower return? I will only do it if I am getting them for a cheaper price. Now, during the last few months, as all of you have been hearing, that economy is not in a good condition. We are in a recession and macroeconomic conditions are not good. Hence, VCs and startups, that is SVB's depositors, went to SVB and asked back for their money. Fast forward all of this to 8th March when SVB made an announcement. And this is the tipping point when things really started to go south. SVB announced that it was forced to liquidate $21 billion of its treasury portfolio at a loss of $1.8 billion to give the money back to its depositors. Furthermore, to fill this funding gap, it announced that it would sell $2.25 billion of its own stock. Now, this created a panic in the stock market and SVB's stocks fell by over 60% on March 9th, Thursday. This in turn scared the investors more and the bank cancelled its stock sale plan. Moreover, venture capitals began advising their portfolio companies to go to SVB and withdraw their money. This created a bank run. Everybody wanted to withdraw their money from SVB. On Thursday, SVB's customers attempted to withdraw $42 billion, which is a quarter of its total deposits. As a result, the bank ran out of cash. On 10th March Friday, the Federal Deposit Insurance Corporation (FDIC) took over the bank to undertake the sale of its assets. Now the bank is out of money. So what will happen if depositors go to the bank and ask for money? Well, just like in India, you have depositors insurance of up to 5 lakh rupees. Similarly, in the US, FDIC provides a depositors insurance of up to $250,000. But here's the thing. Most of these big VC firms, they had accounts much larger than $250,000. So their money is stuck. Will startups face problem because of this? The answer is yes. Note that SVB's money is also invested in Indian startups. Can there be more layoffs? Yes. Could other banks face similar problems? Again, yes. Will this lead to a global financial crisis? Most probably not. Because fundamentally, this is a different issue from what happened in 2008 crisis. This is not a case of subprime mortgage or someone making a bad crypto investment. Bank run has always been a problem in the banking industry, and FDIC is properly equipped to handle such problems. Startups and VC's money is stuck with SVB. It's not gone, it's there. The good news is that many debtors have come forward who are willing to lend the money to startups affected by SVB crisis until the startups can get their money back from SVB. I hope you understood this whole crisis. If you found this video insightful, then go and hit that like button and press the bell icon to subscribe to my channel. I'll see you in the next video.